So my name is Jennifer Compton, and I'm with JNL Communications, which you see the logo for here. On the left, we are a full services marketing and communications firm, and we're doing some work with Bill to them with his marketing. So again, just a couple quick housekeeping things here. Bill had just covered off on, Zoom fit to scale. I think we want to make this an open dialogue, and feel free to interrupt Bill along the way in a nice way. And if you have any questions or comments throughout the presentation, if you could just actually use the raise your hand icon there that you see. And if you have any technical difficulties like I just did, feel free to text me. I will be sure and try to help you with that. We're also going to be doing some live polls throughout because we want to, again, make this a really interactive conversation. And so I will launch the polls and wait for you guys to give us your thoughts, and then we'll take a look at some of the outcomes there, and then we'll package those up at the end. There will be an open discussion at the end of this. We'll take about 45 minutes to do an open discussion. So if you don't feel like you want to raise your hand throughout the presentation, but you want to kind of save your comments for the end, that's fine too. And then we will be giving a post-webinar survey to you via email, which we would just love your feedback on. And I think that covers off on any of the housekeeping things. So Bill, if you want to take it away.
I do, Jen. Thank you very much. Okay, so the primary purpose of today's presentation is to share with you the results we had of our survey that we just conducted in last week, and we'd like to dig right into those numbers right now for you, and then start a dialogue about them. So the first thing we'd like to do is just give you the takeaways from last survey that we did, which was in May, and a couple key findings from that. I know some of you were on that webinar that we had, and that'll be a little repetitive, but we'll go quickly through that. And for those of you that were not with us for that presentation, might be some important insights. We'll then talk about the June liquidity survey that we just completed, and go through that detail length with some length, and then maybe open a conversation while we're doing that. And then we'll talk about some actionable recommendations for commercial aviation suppliers that have liquidity concerns, and then we'll open it up to an open dialogue. So the first thing we'd like to do then is talk about the takeaways from May. And what we thought was fascinating in May was that 33% of the respondents said they were concerned about survival of their companies. These are all commercial aviation suppliers. That was surprising to us that only 33% were concerned. Now we have a poll, but as I'm looking at our system right now, I think I'm getting an error that the polling is not functioning at this point in time. And Jen, I think you may be seeing the same thing that I'm seeing.
I actually have the poll,
and
I'm happy
okay,
to launch
good.
that.
I'm just reading your technology, so go ahead if you would.
Okay. First poll coming up here. Let me launch it. There we go.
Okay, so the question is, are you surprised that only 33% and the respondents in May expressed some level of concern? And I believe there's almost 40 people on with us right now. And so if you guys would go ahead, Jen.
We're getting, we're getting responses in. I think we're at a good place here. So I'm going to close and I'm going to share those results. We've got that 62% say, yes, that seems too optimistic, and 38% at no, that seems right to me.
Okay, so this is in line sort of with our thinking that something was amiss in May, whether it's that the individuals that we simply had a sample of in May, and there were about 60 of them that we spoke with, they're just, they're entrepreneurs and they're optimistic types, or maybe people just don't want to express how they really feel negatively in a survey. If people want to go ahead and raise their hands and people want to talk about this right now, we can. Jen, I'll let you manage all that. Otherwise, we'll move on to some more slides and we'll continue the conversation. But I'm happy to be interrupted as we go through this and make this very iterative. Thanks, Jen.
Sure.
One more slide about May. We talked about this at length in our webinar in May, that the payroll protection program really was a great program. And this is not going to be a political conversation, but economically, it actually was a great success. For the suppliers in the commercial aviation industry that got hard hit, and we'll talk about some of those hard hit stats later on, the payroll protection program really did three wonderful things for us. And remember, this is for companies with less than 500 employees, which is Alderman Company's target market. It helped those companies fund the retention of their employees, which really was, a critical global macroeconomic factor. But in terms of individual micro companies, it really helped. It helped companies sustain their operations because it didn't just pay for payroll. 25% of those funds were allowed to support overhead like rent and utilities. It also provided confidence in the future. And so maybe the reason why we were all a little surprised that these CEOs we spoke with last month were not more concerned is because they got a shot in the arm from the PPP program, and that was rightfully giving them confidence. So maybe we saw that in May, but that's what we saw in May. And let's go into the June survey, because that's why you all joined us, and I believe a number of you were participants in the survey. Now Jen told me to go quickly on this slide, and I'm going to follow Jen's instructions. I do what I'm told. But yes. We don't want to go into the detail of how we built our survey, but we put a lot of work into designing and executing this survey. And Jen told me to say, if you want more stats on this, we'll give them to you. Otherwise, I'm supposed to move to a slide that you find more entertaining. So next slide.
Good job.
The question we asked of our sample of 65 companies, the majority of which were CEOs, what was your change in revenue May to May? Now, this is anecdotal. People can fudge the numbers, but we went to a pretty good audience, and we think people were giving us pretty good facts, but we can't vet this information. It's a survey. Based on the survey, the average response was revenues were down 35% month to month from same month year to year, okay? That doesn't match, but it may make sense, and we got a poll question here in a minute. It doesn't match what happened to traffic, right? And the US government is actually doing a very nice job right now through the TSA, which is part of Homeland Defense, of putting out passenger statistics now per day and mapping them against prior year, which is extremely helpful data to all of us. We have access to that data. It's public, and we crunch the data. And the low of the market so far was April, the week of April 12th. This is done actually 2-week shots, just so you don't have a million data points. But the 2-week period, middle point, April 12th, we were down 96% traffic from prior year. And the rough nominal numbers are 2.5 million. Okay, that's where we started. And it oscillates during the year based on the day of the week and holidays, etc. But for the most part, we were about 2.5 million passenger enplanements per day in the United States. Dropped down to 96. We're back up to 81 down, right? So we're improved 15 points on this. There's a lag, and I think we all on this phone call understand this. That if you are a supplier to an airline, whether it's a service or maintenance or legal services, passenger traffic changes are not going to cause the airline to have less demand for your services that day. There's going to be a lag. Even the purchase of jet fuel goes into storage tanks before it's burned, right? It's not the next day. So there's a lag. Obviously, fuel's a short lag. Things like engine overhauls every 7 years, it's going to be a very long lag. So maybe the 35% average revenue down was actually a very accurate number, but it had a lot of lag built into it. Okay, I mean, obviously from this data, we don't have enough granularity to know any of that. But as we move to the next slide, and I apologize for pushing the button twice here, we're gonna have a poll in a second, but we asked these 65 CEOs and CFOs, et cetera, when do you expect traffic to return to pre-pandemic levels, right? The roughly 2.5 million a day. And the answers we gave them was multiple choice question. August or December, very few. A vaccine, 26%. But if you look at post-vaccine, it's 63%. And what we are hearing anecdotally is, yes, once a vaccine is invented, that's terrific. But you're going to have to vaccinate a meaningful portion of 4.8 billion, or rather 8 billion humans. Some of the literature says 4.8 billion vaccines should be enough to vaccinate humanity. But whatever it is, day of vaccine doesn't necessarily mean the world's vaccinated. And that's what we got out of this data, was that people are thinking it's going to be 6 months, 12 months, 2 years or more. And 63% of people we asked said it's at least going to be 6 months post-vaccine. So, Jen, I think you've got a poll question for everybody here. I think it's pretty much the same question.
Okay, I'm launching. When do you think passenger traffic will return to pre-pandemic levels? Quick poll for everyone. Okay, I think we've got a good. So it looks like nothing for later this year. 16% for 2021, 56% for 2022, and 28% at 2023 or later.
You know, that relatively seems to match with the overall survey that we did. Not exactly, but we asked the question a little bit differently, intentionally, but that's pretty consistent with what our survey said. So that's actually nice to see. All right, Jen, let's go to the next one. So the next question we asked was, do you have sufficient liquidity? We didn't define that for people. We let them manage that themselves. I think we all have a sense of what that means. It means, you know, having enough cash to be comfortable, or make payroll, or reinvest, or whatever your comfort level is with sufficient. But given the potential ambiguity for that one word, 38.5% seem to be saying that they're concerned about liquidity. 35% said yes, they're sufficient, and 26% said probably. But the exact language we gave people to answer in a multiple choice question here was maybe not if the recovery is slow. Well, we just answered that question, right? It's not going to be in the next 6 months. It may not even be next year. So 18.5% are flagging or checking the box to say, I'm concerned about liquidity. And then the same response, that's the green box if it's swift, but we say it's not going to be swift. The purple box if it's slow, which is the inverse of the same question. And then flat out 6.2% are already saying they don't have enough liquidity. So it's about 40% of the market that is now saying they're worried about their liquidity. Okay. And I think we have a poll question on this one, Jen.
Great. Third poll question here is, do you think suppliers will have liquidity problems soon? Well, that's a resounding, yeah, okay. Okay, I'm going to share that. 91% at yes, with 9% at no. Yeah, that came in pretty hot.
Okay, not surprising, right? Not surprising. I guess the question really becomes when you get granular. What does it mean to have a liquidity problem, right? Which we're actually going to get into. So I think we're going to have a fun conversation. Maybe not a fun topic. I don't think anything about COVID is fun. But I think we're going to have a, shall we call it, an engaging conversation. Fun's probably a bad word choice. Jen's probably going to write me a memo after this about my word choice there. Okay, so question, are you more concerned than you were 30 days ago? This one surprised me. I just keep looking at this and I keep scratching my head. So given all the data we just saw and the responses we got from this audience, same audience, right? Exact same audience. We didn't go to different audiences for different questions. Same folks, right? Are you more concerned? Well, interestingly, more than half effectively said, not effectively, did say no, right? So 40% actually said they're less concerned than they were a month ago. That's how they answer the question. And I double checked the logic of our question. That is exactly what we asked. 12% said no change in their concern. Well, that makes sense to me. And 48% said they're more concerned. I got that. I just personally don't get the less concerned 40%. So Jen, it's time for another one.
Okay. Question 4 here. I'm going to launch that. Why do you think 40% of companies reported being less concerned in June? Okay. Close this and share that with you. So we've got increases in passenger traffic at 9%, reopening of the economy, not surprising, 35%, advancements in treatments or vaccines at 17%, and unwarranted optimism at 39%.
Wow. That's really insightful. I just, yeah, that's very insightful. Let's leave that for an open discussion rather than me pontificating on it. Let's leave that one for everybody to talk about when we get there. All right, let's continue. We only have a few more slides, guys, and then we can get into the good stuff, which is talking to each other. We asked the question, what's your current focus? And 58% said cutting expense to some degree. We asked it in 2 ways. This was multiple choice, single choice, 5 questions. 32% said they were cutting expenses to match a decline in revenue. 26% said they were cutting expenses ahead of expected declines in revenue. And this is not traffic, right? We didn't ask about traffic. We asked about their revenues. So these are suppliers, 32% saying I'm cutting my expenses to actually match revenue drops as we go forward. 26% are cutting expenses for what they believe is going to be future drops. 20% are, and this was what is your number one focus? Not obviously everybody's got lots of things to work on. This is what was your number one focus as running a company. 20% said their single focus was efficiency of operations. 11% said new business development. That's interesting. And 11% said investing in growth. We sort of asked the growth question in 2 different ways. You can maybe argue that's 22%, but 2 times 11 for investing in the growth curve of the business. Question on this one, a poll for everybody, Jen.
Okay. Question 5 here is, which action do you think is more appropriate for suppliers right now? Okay. Results are in at cutting expenses to match actual declines in revenue at 18% and cutting expenses ahead of expected future declines at 82%.
Okay. Again, I think we'll leave that for further discussion.
Okay.
Thanks, Jen. Okay, so now recommendations for suppliers. I think we've only got 2, maybe 3 more slides, and then we're opened up for dialogue. I'll go through these quickly because I do want to save at least 15 or 20 minutes for us to talk to each other. But there's a couple things in here that I do want to stress for everybody, and I think it's important to stress just a few things here. Clearly, managing liquidity is important during the downturn, right? That's the point of our survey. That's the point of this conversation. And I want to make a couple takeaway points based on our experience of working with companies in the supply chain through really 3 downturns in my career, right? Never like this, but the Lockerbie downturn in 1990, and then 9/11, and then the Great Recession to some degree. But nothing like this. But I've been through 3, and I've done a lot of work with companies that are facing severe downturns, whether it's a micro basis or macro in this sector. The market winners always, every time, when you look back, when you're in the good days and you look back at the bad days, the winners coming through that were those who manage cash better than their peers. There's a lot of different things to do to be a winner of market share. Better products, better costing. In a downturn, market share winners manage their cash better than their competition. Cash becomes the focus of the business. The CEO becomes the CCO, as I call it. It's sort of a joke, but it actually really does work. Your CEO is your chief cash officer. Money does not leave the company without the CEO knowing about it. Every dollar. Now, if you're a $100 million revenue business, maybe it's not every dollar, but if you're a $10 or $20 million business, No check gets written or cut without the CEO knowing about it. Cash is too precious. And we moved, FP&A moves from GAAP to TWCPs. Now, I'll get to TWCPs in a second, but FP&A is financial planning and analysis, right? I mean, the CEO and his or her team run the company by metrics, whether it's throughput or days turn or turn time or whatever your metric is as a CEO, you run your business based on a bunch of metrics. Our recommendation to you is they need to have one new priority on top of every other one, right? So if quality was important to you, keep measuring it, right? And if overtime was important to you, if things are important to you, keep measuring them. But on top of everything else, you now manage cash. And we do not manage cash with a GAAP financial statement. We don't look at gross profit. We don't look at net income. We don't look at EBITDA. We look at a 13-week cash flow projection, cash projection, TWCP. I'll come to that in a second. But the TWCP is the tool for managing the business, bar none. Number one, that's the CEO's job. Look at the TWCP every single day. That will drive the burn rate. The burn rate is, for those who haven't seen that term before, and we're going to define TWCP in a minute. But the burn rate is pretty simple, right? You're burning cash. In a downturn, you're burning cash. If you can get your burn rate to zero, that's great. It means every day you don't need to worry because there's the same amount of cash as you had before. When you're burning cash, you have a fume date. So you have a burn rate and a fume date. If I lose $1 a day and I have $10 in the bank, in 10 days, party's over. It's that simple, right? It's very complicated to do TWCP. So before we go anywhere, a polling question about what a 13-week cash projection is. Jen, you want to hit the buttons and we'll ask people our question.
Yeah. Are you familiar with TWCPs? Okay, I'm gonna share that. Okay, so yes, I have used them in the past, 33%. Yes, I know what they are, 19%, but a big population is no.
Okay, so quickly here, and then we can do this offline, and anybody that wants to pick up the phone or email or whatever in this new virtual world of not actually meeting with each other, I'm happy to virtually meet with anybody and talk about it. A 13-week cash projection is a tool. We have them standard and they get customized, but it's a tool typically done in Excel, and it is a financial analysis tool that helps you literally look at your forecast for cash in the bank 13 weeks forward on a weekly basis. And if you do them right, and we try to help our clients do them as well as humanly possible, you will be able to actually look at the bank account in 15 days, and the money that's in the bank on that day will be the number you thought it was going to be 15 days prior. And when liquidity is short, that tool is how you run your business, okay? Because if you run out of cash and you can't make payroll, there's nothing else you can do. The party's over. So you want to manage the cash so that you can then make all the other important decisions about running your business. Okay, next slide. And this, I think, is the last slide, Jen, before we go into open discussion. So there's two things about being low on liquidity. One is you want to manage your burn rate, which TWCPs help with, and the other is you want to push out your fume date. So if you're losing $1 a day and you got 10 bucks in the bank, if you can get your hands on another 10 bucks, your survival just extended by 100%. Okay, and that is what we're talking about here, right? I mean, all of us and all of you and all of your colleagues in the supply chain, you're all running great companies, or you wouldn't be in the supply chain right now. It's a competitive marketplace, and although we had a lot of revenue, if you weren't doing a good job, you couldn't have survived. So we're all good suppliers. The issue is we got to get through this to the other end. And if you run out of cash, you're not going to be there when the market recovers. Now, it may be 2021, it may be 2022, it may be 2023. We all think it's somehow related to a vaccine. Hopefully we get one soon, right? There's some already great news about what may get one this year, actually, right? So we can all hope, but you can't make payroll with hope. And so pushing out the fume date as you work down the burn rate is a requirement. And what's that mean? It means getting your hands on cash. Well, how do you get your hands on cash? Financing sources. And I'll end here, but we can help with all of this, right? We can help you talk to commercial banks. It is getting to be a point where if you don't have a guarantee, you can't get financing from commercial banks in this sector. Whether it's a personal guarantee and you put your personal stock portfolio against the loan, that works. But the SBA, I mean, the PPP program was a federal government through the SBA to get a commercial loan. They're actually commercial loans guaranteed by the federal government. Non-bank lenders, there's lots of them. We have relationships with them, CIT, Fortress Capital. Some of them have billions of dollars in the sector already. They know what they're doing and they are prepared to lend selectively. Strategic actions, alliances, joint ventures, mergers, acquisitions, that's our bread and butter. We can help you with that. A rights offering, real quickly, especially for smaller companies, may not be an actual public market rights offering. It's probably going to be something like where you work with your existing owners and you develop structures for financing from them, whether it be straight equity, preferred stock, subordinated debt. It's a lot to do there. We're glad to help you with it. And then restructurings, right? You actually can push out your fume date. If you've got a $12 million term loan coming due in December, well, that's your fume date right in your face. If you can simply renegotiate that loan to be a 3-year loan that amortizes starting in 2 years, well, you just saved yourself, that's survival right there. So renegotiating debt is a great solution to pushing out the fume date. Happy to help you with it. And then if you can't do it out of a process, you do a DIP financing, which we can talk about as well. We have a polling question that's not really about DIP financing, but we have a polling question about financing sources. And this, I think, is our last polling question, and that's our last point. So after this, we can chat.
Yeah. What source of financing do you think will be most readily available to suppliers during the pandemic? Okay. We've got commercial banks at 19%, non-banks at 43%, strategic actions at 19%, nothing for rights offerings, and then restructurings in at 19%.
Wow, that's really interesting. Actually, I was not expecting that. Okay, all right. So Jen, I think that's it for our prepared remarks. And I think we want to open it for open discussion. And I think you're going to tell us how we're going to do this.
So I think, let me just see a raise of hands if anyone has specific questions or anything you want to discuss. It's part of the open dialogue. And I will click on you. Okay. I don't see any raising of hands, but I do have actually one question that's come in anonymously, actually, Bill. And the question is, do you expect more government funding?
Good question. I think I can guess who asked that question, but I won't divulge my thinking. The French government just announced a multi-billion euro program for the key suppliers. I don't think it's been approved. What I read was that it is being debated in the legislature, but it's a multi-billion-dollar financing package like the CARES program. And I think it's going to get approved. And so globally, I think that governments are going to support the commercial aviation industry. And I think the United States is going to do more of it. It's going to be selective. We're going to have to protect the national balance sheet at some point. We can't just take on unlimited amount of debt. But I think to allow the industry to actually go through massive layoffs, lose all that intellectual talent and human talent, and then try to recover on the back end and its linkage to defense aerospace, I just think that it is likely there'll be government financing. My concern is that if you're Spirit Aerosystems with thousands of employees and you're making sections for the P-8, which is a military aircraft, also a Boeing aircraft, 737, you're going to get government financing for a lot of different reasons. I'm not sure what it's going to mean to be a supplier to Spirit. So it's going to be dicey. Whether it's truly all the way down through the SBA, again, like another PPP funding, now we're getting into real political questions. But I think at the highest level, like they just did for Safran in France, I don't doubt there'll be money for the top of the supply chain.
Okay, great. Thank you. Let me see. Oh, I see another hand up here. Okay. A question. We have a question from Rob Henderson. Rob, can you, I hope I unmuted you correctly.
Oh, yes, you did. I was waiting.
Hey, Rob.
Awesome.
Thank you. Hey, Bill, great stuff as ever. Looking at the stats around passenger traffic returning to pre-pandemic levels, I'm wondering, do you expect any airlines to go out of business given that the forecast is pretty, should we say, negative?
Yeah, so, and I hear your British accent, Rob, and I know where you live. So I'm going to say this. I think globally there are going to be a lot of liquidations. There already have started to be bankruptcies, and I think some of them are actually going to liquidate. But I'm going to make my response U.S. based, and I believe that even the smallest of what I'll call the major carriers. I don't see liquidation. You know, and the majors, I mean, the Southwest, United American, Delta, I can see them downsizing permanently. I can see them exiting some routes for a very long period of time. I can see them exiting aircraft. I could see maybe an in-court bankruptcy process. But I also could see out-of-court settlements on all this stuff. And so I think the answer is, do I see a TWA airline gone type of activity, either through merger or true liquidation? No, in the US, I actually don't see it, but I do see the entire market shrinking for some extended period of time.
Okay, thanks.
Yeah, thank you.
Here.
We have a quiet group.
We do. I have one, let's see, I think this is coming in as an anonymous question here. Yeah, one more, Bill. Spirit Aerosystems and Boeing are in talks. What does that mean for smaller suppliers?
Yeah, and I'm not sure what those talks mean. I think it's good, right? I mean, the fact that Boeing is having conversations with its large supplier is healthy. I think it's good for the suppliers because it means that Spirit is not going to just go dark and lay everybody off. And so I view it as optimistic. I view it optimistically for the supply chain. And Jen, I'm actually on my screen getting a number of questions now. Yeah,
I saw a couple of hands pop up, so I'm gonna unmute Dennis Santerre. Hope I didn't butcher your name there, but Dennis, you're up.
Hi, Jennifer. Hi, Bill. Yeah, great webinar. Thanks for inviting me. Question is around picking the winners and losers in the supply chain. So if you're a Spirit or if you're a Lockheed and you've got, you know, hundreds and sometimes thousands of suppliers, lots of commercial exposure, potentially some defense support, you know, what's the balance there between, and what have you heard in terms of like how bad off the supplier is versus how sole source, how critical, how sole select the supplier might be, and are folks taking measures to, you know, not only accelerate payments and help out with liquidity, but also, in the background, we're kind of looking for an alternate source on this part. Maybe it's that golden screw dilemma or something along those lines. But any initial sort of tea leaves on that dilemma?
So I'm gonna make sure I got the question, Dennis. And really, it's a question about, can we somehow see, predict, expect who's going to win and who's going to lose in this pandemic?
And in some ways, influence that, right? The tier ones and the primes can have a real impact here. And you're right, if the government starts to steps back in and provides payments to a Spirit, is Spirit right to then turn and go to the supply chain and accelerate their payments so they keep them in business,
Right.
in effect selecting the winners and losers?
Right. So supply chain management is going to be, I think, less important to the tier 1 and tier 2 players than it used to be. It used to be that the tier 1 and tier 2 players, they're literally their number one focus after quality and after winning programs was optimizing their supply chain. That's where they really put a lot of effort. I think that's going to change. I think they're going to be relatively agnostic to who wins and loses. Number one, they don't want the liability, right? Because not that it's lender liability or creditor involvement, but you don't want to see a lawsuit that says, well, XYZ company, you gave this guy work and not me work, but I was on a contract. And so I think the suppliers are going to be a little weary of that kind of claim against them, whether it's a legal claim or just in the marketplace bad reputation. But also, they're going to just let the marketplace do its thing. I think that they're going to have, on very few programs do they have single source at tier 2, tier 3, which is what we're talking about, right? Boeing has some single source suppliers, but they learned that lesson with Millennium. So unless you are truly sole source, and everybody likes to say they're sole source, but how many really are sole source? Unless you're sole source, the OEMs, I think, are going to be agnostic, Dennis. I think they're going to say, look, I'm sorry you're out of cash. I don't need more of those widgets. I'm sorry. You got to fend for yourself. I can't protect you. I've got to save myself. I'm not sure I answered your question, maybe.
No, I think that's a great perspective. I think it really does come down to that golden screw, sole source, sole select, and like you said, verifying if they are indeed, and if they are, then those are the winners you pick, and the rest you kind of let the invisible hand work on.
Yeah, I think that unless you are literally sole source on some part that they can't easily have made somewhere else, I think it's just going to be survival of the fittest.
Thanks.
Unfortunately. I see some questions here, Jen. I'm not sure if you're seeing them. I've got a question here from Jeff asking about multiples. Let me see if we can. Do you see Jeff, and we can get Jeff's voice and let him speak for himself? Let's see. There he is. I got it, Jen. Let's see. Okay. Jeff, I think we just unmuted you if you want to speak.
Hi guys, can you hear me?
Hey Jeff, perfectly. Thank you for joining us.
Actually Luke, but everyone calls me Jeff, so no worries on that. Better for you to
No, I'm sorry, Luke.
No, that's all right. Jeff never answers the phone, so that's fine. No worries.
Sorry.
Yeah, no, I was just interested that obviously with everything going on in our industry right now, how that affects the multiples, the really high value companies. We've seen some huge transactions over the last few years. The Honeywell CEO's come out and said that multiples and valuations are going to be lower now, and maybe they might come into the game a bit more. But I just wondered if you saw, double-digit multiple transactions. When do you think that might happen again in aerospace?
Yeah, Luke, it's a great question. I apologize, I butchered your name. I'll make two comments. I think it's going to be a while before we see all overall average multiples go back into those levels they were at pre-pandemic. It's going to be a long time. I don't know, 3 years, 5 years. It's not going to be 2022. I don't see it. Now, I think reasonable multiples based on expected future cash flows, which I'll come to in a second, and selectively, right? If there's something going on, there's an AD on every airplane in the world, and you're the only one that makes the part that goes in the AD, and they're flying off the shelf, even though there's only 20% of demand of passenger traffic in the world that there used to be. Your part's flying off the shelf because you're a little tiny company and you got the AD. Well, your multiple is going to be enormous, right? But let's ignore those, I'll call unique situations. The average company, multiples have dropped. I think they've dropped more than the public equity markets are saying, at least the tier 2, tier 3 deals that we're seeing. And we are seeing deals happen. We've got 3 in the market right now. We just closed a deal in April. Deals are getting done, but here's what we're seeing. and this is classic, right? The sellers want a pre-pandemic price. Forget multiple. The sellers want a pre-pandemic price, and the buyers want a post-pandemic price. That's not rocket science, but those numbers are so vastly different that there's friction in the market. And more than half of my business is being an M&A sell-side broker, and brokers don't like it when the buyer and seller have wildly different views of value, right? We get deals done when both parties sort of see the same number. That's how you trade. And so my comment to you is, I'm not so worried that multiples have fallen. What I'm worried about as the M&A guy is that price expectations are so skewed that one party wants a number that the other party rolls their eyes at, that M&A volume is going to fall as much as traffic, because those parties can't get together right now. They have too wide a gap in their view.
Yeah, no, that's great. I appreciate the insight on that, especially that view of, the sellers want the pre-pandemic pricing, and then obviously now the current buyers want to take advantage of. I guess it all depends on the impact as well, and people are maybe speculating it's just a year write-off, but obviously some of these forums and everything is saying it's much longer than that. So yeah, I appreciate the insight that you can give on that.
Yeah, I mean, look, we're selling a business right now. It's a small business, but their revenues were up 42% in the first 5 months of the year. Why? Because they're doing something in electronic warfare. Well, yes, they've got some commercial aviation exposure, but we do defense work as well. They've got a big portfolio of RF, EW, and there's a lot of concern at the national security level about that kind of defense. So that goes to the micro, right? If your revenues are growing 42%, your backlog is enormous, then your valuation should be relatively high, and the buyers should be willing to pay for that. All right, Jen, I think we're out of time. Do you want to take one more?
We are. We've got, we've got 2 questions from Michael Lippitz, and we've got one from Kevin Gould. So maybe we could touch on Kevin's question and one of Michael's, if that suits, or okay. I'm going to unmute Kevin, who has a question about a shift in demand. Kevin, over to you.
Yeah, good morning. Thanks for hosting this, Bill. I'm just thinking about, as fuel prices are relatively low and the economy is constraining perhaps investment capital's availability, are airlines and other operators going to shift their demands toward refurbishing and resurrecting older airframes and away from buying new airplanes? Do we think a shift like that's going to take place?
Great question, Kevin. And I know that you've been in this industry for, I won't say how many years, because you're still a young guy, but you've been in this business a long time. And yes, you're absolutely right. The manufacturers are going to suffer, not just because fuel is cheap, although that is clearly a factor that makes new aircraft less valuable. 100% agree with you. But because there's so much excess capacity right now of good quality aircraft that were flying 2.5 million people every day, and there's now only demand for less than 400,000 people a day, that whether you need a new tire, new landing gear, new engine, or you need an entire new airplane, the make, buy, repair decision, everything pointed to grab one from the back. Right? I mean, I equate it to you got 15 pickup trucks, right? And you're trying to keep them all running because you run a business that needs pickup trucks. But all of a sudden, right, only one pickup truck is needed a day. Well, you would never buy a part or maintain that truck. Anytime a truck breaks, you park it and grab one of the other 14 you're not using. And so, yes, fuel is important, but I think we're seeing such a cut in the demand for the fleet that I think OEMs and service providers are simply going to see a lack of demand across the board for old and new until that capacity comes back and those aircraft that are grounded are back up flying again.
Great, thanks.
I want to get to Michael, which I think actually is a question all in one. It was my mistake. It's a health and safety question. So Michael, let me unmute you quickly here. And Michael.
Michael?
Are you there, Michael?
My system says he's there, but looks like we've lost him.
Okay. Well, his question just for the group was, what's your view on safety of health and safety of commercial flights?
Yeah, so not a scientist, and I am a commercial pilot, but I'm not a scientist. So aircraft do a really good job, modern aircraft, of recirculating fresh air. Comes in bleed. It's ambient air from 35,000 feet. It gets pressurized, cooled, because it gets heated when it comes in. It gets cooled and put in the aircraft. They do a really good job with HEPA filters and all the rest. I'm not so worried that the science of the airplane is going to spread the virus and people are going to get sick on airplanes. That's a real concern. I'm more concerned about the psychology of the average traveling passenger. Whether people get sick on airplanes or not is going to be a scientific fact that, from what I've read, not much worse than getting on a train or a bus or anything else. Potentially better than getting on a bus or a train. But clearly not the same as standing in the middle of a football field, right? And this is common sense. What I'm worried about is not the science. I'm worried about the psychology. That if the average American, fact or not, thinks that they are exposed to getting COVID on an airplane, they're not going to get on airplanes. And the reality is, after 9/11, nobody died on an airplane because a terrorist bombed the airplane, right? Nobody, right? There were some attempts, but nobody. As I understand it, not one human being died because of a terrorist bomb after 9/11. But traffic plummeted because everybody was afraid of a bomb. So I'm not worried that there's going to be a COVID outbreak on an American Airlines flight, although that would be awful and it would, I'm worried a little bit. What I'm really worried about is, are 2.5 million Americans every day going to feel safe flying? And that psychology is so ephemeral. I have no idea when the average American is going to say, let's get on a flight and I feel comfortable.
Yeah. And just to clarify, Bill, Michael doesn't have a microphone, so he wanted me to read that out. And so he is still with us, but so thank you. Thank you, Michael, for letting me know. I have a hand raised from a Bob McCabe that I'd like to try to get to if we can. Bob, are you there?
I'm here. How you guys doing today?
Hey,
Hello,
Bob
how are you?
Good to see you. Hey, so someone just touched on it. One of the questions I have is, like you said, with the price of the fuel so low and the amount of what do you think Boeing and Airbus can do with the airlines and the aircraft lessors to get manufacturing going? I mean, we definitely need that to happen. Like, what kind of incentives can they offer? What else can they do?
So you broke up for a second, Bob, but I think the question is, what can be done to help the manufacturers with their production?
Correct. Yeah, I'm just saying, with the amount of aircraft that are out there, people can just buy a used aircraft, but we need Boeing and Airbus to manufacture new aircraft. So, what incentives can they offer the airlines or the lessors so they continue and start buying more aircraft again?
Yeah. So I think your point is 100% correct on the issue of the OEMs need to keep making aircraft. 100% agreed. I don't think it's the airlines that are the solution. I don't think the airlines have the liquidity or the appetite or the demand or desire to do anything when it comes to buying airplanes right now or leasing them. So I think the issue is governments, right? I think in the United States, it's the federal government. In France, it's the French government or it's the EU. And what I see is that the major suppliers, and I use the language that was used earlier in our webinar, sole source, right? Boeing is a sole source supplier of certain military products to the United States government. Boeing is almost a sole supplier of commercial aircraft to some airlines around the world. Boeing can't fail. It's a sole source supplier. And Safran can't fail. It makes the Rafale and all the other engines and things that France and Europe need. And so if that's really the case, that you can't fail, it can't be allowed to fail, and the marketplace has no demand for the product, then whether you call it socializing it or government loans or government subsidies, the government needs to step in. And so Boeing needs to manufacture 3 737s a month so that it can just learn and remember how to make a 737, so when there's real demand, they're capable of doing it. then it's not American Airlines just going to say, yeah, I'll be nice, I'll buy 3 airplanes from you a month. It ain't going to happen. What's going to happen is the United States federal government will put a program together that will say to Boeing, we'll give you enough funds to make 3 planes a month, and you're going to park them for 4 years. That's what I expect.
All right. Well, thanks for your answer, Bill.
Hear your voice, Bob.
All right. Good seeing you, man. You have a good one.
You too, sir.
Thank you. Bill, I think that's all of the questions that we have right now. If I've missed anyone, please raise your hand now or type into the question box and we will get to you. If not, you have my cell phone. Feel free to text me, or you have Bill's information as well. So we'd love to hear from you post wrap up if you have a question that you didn't want to share here on the webinar.
Great. And Jen, I think we're going to post this next week. Is that correct?
That's right. Oh, one more question. One more. Want to take a last one? Thomas Bruns. Thomas, are you there?
Hey,
on the MRO side, I'm wondering on the MRO side, with the airlines in a kind of a cash and profitability crunch, whether you think airlines worldwide will be taking a fresh look at PMAs or DER repairs, where they may have shied away from that in the past.
Yes and yes, Tom. And by the way, good to hear your voice. I haven't spoken in a while. Yes and yes. I think that the PMA DER route can potentially save a lot of money for the operators. And I think that, you know, it's been proven over the years, although there's some issues with lessors and other parties not wanting DERs and PMAs. So there is friction in the market, but it's been proven to the airlines, all of them, right? Started with FedEx and it went all the way to American Airlines by the end. They all know that a PMA part made by a quality company is safe and reliable, potentially better than the OEM part, and it can save them a lot of money. It's just, you know, we're beyond the conversation in the marketplace about, is it safe? Should I, would I, could I? And so if you ignore the friction of the leasing companies and others that are sort of against it, but you look to the airlines that are now in a liquidity crisis and every penny counts, I think PMA and DER is going to be more attractive. I think it's up against the headwind of substantial USP, right? Sorry, not USP. I'm thinking other things. No, it's right, USP. Serviceable unused parts. Tom, you're the expert here. I'm saying it sideways, but serviceable parts. I think you're going to have friction against it, that there's going to be so much surplus in the marketplace of high quality parts, whether it's from teardowns or whatever. I think you're going to have some pushback against demand for PMA DER, but I think net, I think it should be somewhat positive.
Thank you.
We've got one, Joe. I'm gonna get you our information right now, and then Carol Anger has a I think a great question. If she is still on, let me just try to unmute Carol here about the business traveler, because you touched on the personal traveler psychology. But Carol, are you there?
Actually, it's not Carol, it's Scott Carpenter. I used her
sorry.
sign.
Oh, okay, I was like,
God, that is so typical of you, Scott.
Sorry, Bill. So, you know, I never got an email yesterday saying I was accepted, so I used hers.
Oh. Sorry about that.
That's going all right. It's going all right. We get around things. That's how we stay alive.
Oh, good. I'm like, I know I didn't butcher the name that badly, did I?
No.
Okay. Okay.
What do you got?
Oh goodness. My question is, you touched upon the public, the regular vacation traveler, you know, the psychology of whether or not they'll come back. I actually somewhat disagree with you on that standpoint. I think most people are going to want to get out and go to vacation destinations once they feel a little more comfortable. My concern is the business traveler. I mean, that's where the airlines really make their money, is right. You and I traveling, visiting accounts, and everybody else on this call. You know, will companies even allow them to travel going forward? God forbid somebody does get sick and a lawsuit comes up.
That's a really great question. I wasn't even thinking
I'm saying that I was forced to travel to go visit and I got sick. You know, do you see any issues there going forward? At least until we have some kind of a vaccine.
No, Scott, look, I didn't see it until you just said it. And now that you said it, yes. I mean, I wish I had a long answer for you, but I have one short answer for you. I agree. Yes.
Yeah. Because I know most of us, and I'm sure most of us on this phone call, we can't even go visit accounts right now because most of the people we visit are not in the office or they don't want to see us because they won't allow us into the buildings, right?
Right. No, I've heard that. I've heard people saying they want to go meet with a customer, and the customer said, "I'll see you on Zoom. You're not invited."
Exactly.
That's a great point. And
so,
your point about the fact that business traveler is the moneymaker for the airlines is another great point, Scott. So yeah, there are a lot of moving pieces here, and getting back to 2.5 million passengers a day is not going to be an easy task.
No, it really isn't. You know, especially with all these other options to use Zoom, or Microsoft has their own, and there's so many other ways to communicate now with your customers, although not necessarily the best way to communicate. I mean, you got to be in front and talk with people, but there are options that may prevent people from traveling for quite a while.
It's a great point, Scott.
So
thanks.
Thank you.
Let's see. Kenneth Massa has asked about the census of the type of companies that are on this call. I think, Bill, it's similar to kind of the first slide that you went through, but maybe you want to give a quick roundup of.
Sure, I'm happy to respond. So we started out with about 40 people on the call. Some people have exited, but the vast majority are actually suppliers. Most of the people that we were talking with just now on the phone, that we're talking with everybody, I think just about everybody we spoke to, aside from Luke, that I called Jeff, is an executive of a supplier. And I'll run the numbers later based on who we invited. Not everybody that said they were coming did come. Obviously, things change. But based on the numbers we saw before the meeting started, about 75% were from the industry at some level. Some of them may have been board members or lawyers to suppliers. And the balance were lawyers, accountants, professionals, consultants. I believe we have, and I won't say his name, we have one consultant on the phone who spoke up actually, but he's deep in the industry and all of his clients are from the industry. So, but he's actually a consultant. So 75% were directly from the supply chain. And I would say that we've got maybe 5% of people joining us right now that are sort of what I would say new to the industry.
He just followed up with the distributors, manufacturing, comm, or defense, which I think.
Say that again. Sorry.
Distributors, manufacturing, comm, or defense, commercial or defense.
Okay, got it. How many were distributors, manufacturing, commercial, defense? I didn't slice and dice that data. I would say that it's probably an equal mix, and we can run these numbers, but an equal mix of probably a little weighted towards MRO, then the next one was manufacturing, and then a good smattering of distributors. Were those the three? Yeah, I would say the number one was MRO, two was manufacturing, and the third group is distributors.
Okay. Thank you. Okay, we're at the hour. So again, I think, Bill, you had your information.
Just following up.
Let me mute.
We have this thing on our website.
But
If you got muted in that process of trying to.
Did I? Oops. Okay. Can you hear me now?
Sorry.
Sorry about that. I muted myself. If you have additional questions that you didn't ask here or we ran out of time, please, Bill, I know you want to flip back to that first slide quickly where you have our information so that people can just jot that down if they need to.
You got it. I'm going there right now. Okay, it should be coming up on everybody's screen right now.
Great. And that's my number there. So if anyone has any questions, shoot me a text. I will get that over to Bill. as soon as we can. So thank you guys. Thanks for joining today, and thanks, Bill. I think this was a great conversation.
Great. Thank you, Jen. Thanks everybody for attending. Thanks, Jen. Well done.
Have a good day. Thank you.